Friends, welcome back to our channel OMSAI Bhojanapalli.
Good morning, friends. So we are doing the chapter bond valuation, in which we have to complete the convexity calculation in today's class. We will do one problem in value dissection and complete the chapter with a sum which will lead us to equity valuation. From there we'll start with the another instrument called as equity shares. All the concepts about equity shares will be discussing. Please settle down. All the concepts regarding equity shares will be discussing mainly using three chapters: dividend policy, equity valuation itself, and third is portfolio theories. All the three chapters mainly focuses on equity shares. Once we complete all this, then we'll move on to the derivative segment in the next stage. So if you look at our discussion, we are discussing markets one by one. First we started with discussing about the currency markets or foreign exchange markets. Now we have been discussing about the fixed income security markets or the bond markets. Some concepts were discussed. More will be discussing at the derivative segment, where we will be having interest rate swaps, currency swaps, etc., which once again involves the bond markets. And IFM also we have not completed. We only completed the part without involving the derivative segment. That will be discussing once again at the derivative stage. Now we will be discussing next the equity markets and the related issues. Before I complete the convexity, let us summarize what is done in the bond chapter till now and then continue with the remaining areas. Stop talking, please. Settle down. Company requires assets to earn profits. I am hearing voices, please. Company requires assets to generate returns. For the asset, funding is required or financing is required, which can be got from two broad sources: equity, debt. The equity shareholder asks for a variable return for the money given by him, and the debt asks for a fixed income for the money given by him. So this debt instruments we generally call as fixed income securities. That fixed income security which is traded in the stock exchange is called as bonds. The bonds we classified into four types on the basis of cash flows given by it to the investor, namely the plain bond, the annuity bond, the perpetual bond, the zero coupon bond. These are how to calculate the value, yield to maturity, duration and volatility of all these four bond types. Then we discuss about the concept of realized yield to maturity. Yield is what the bond gives its bondholder. Realized yield is what he ultimately earns. What he earns not only depends on what cash flow bond is giving him, it also depends on what he is doing with the bond cash flows. His reinvestment rate is more than the yield to maturity. Realized yield is more than yield. His reinvestment rate is less than yield to maturity. Realized yield is less than yield. Is equal to means equal to yield to maturity. Then we also saw that the bond immunization strategy helps him to protect against the realized yield to maturity getting disturbed due to the interest rate changes in the markets. The immunization strategy says that if you want to invest for 4 years, don't invest in the bond having a life of 4 years, but a duration of 4 years. That strategy will help you to some extent protect or immunize yourself against the interest rate changes. Next, we discuss about the concept of forward rates. Forward rate is the exchange rate, the interest rate decided today for a bond to be issued on a future day. It is found out using 3 terms bond or 4 terms bond. We want to find out the forward rate for a second year. We'll be using a 2-year bond and a 1-year bond to find out that second year forward rate. How to calculate forward rate for a coupon bond, how to calculate forward rate for a zero coupon bond using bootstrapping method has been discussed. Once we completed forward rates, I think next we discuss about bond refunding decisions, which is called as callable bonds, where the company has a right to redeem the bond anytime it wants at an agreed call premium. In that case, when the interest rates are generally falling, the company would like to replace its existing bond carrying high coupon with a new bond carrying low coupon. In that case, what are all the cost benefits of replacement? We analyzed and gave a advice whether to replace or not the old bond with the new bond. Once we discuss the replacement decision, we discuss about the concept of convertible bonds. I think I need not summarize it. We discussed around one class the issue regarding the convertible bonds. Once the convertible bonds is over, I think we derived the formula for duration. I have to give you that printed sheet. I couldn't give it to you today. I'll give you not on tomorrow's class but on Tuesday's class. I'll give you along with the dealer's desk notes also. I'll give both. So need not worry, whatever promised will be given. Okay. So in that case, we saw how to derive the duration formula as well as how to understand the volatility. Volatility is equal to duration by 1 plus yield to maturity is what we call as volatility. Volatility of 3% means when the yield changes by 1%, the bond price inversely changes by 3%, approximately we say. Then we had an elaborate discussion regarding the volatility derivation. Volatility shows the change in bond price relating to the change in yield to maturity. Yes or no? It is dP divided by dy. That is, you differentiate the price with respect to yield. And the first derivative which we get is a constant, or is it a function? It is also a function we saw, because y is equal to 2x plus 3 means first derivative is 2. It is constant. If the function is linear, the first derivative becomes constant. If the function is non-linear, the first derivative itself becomes what? An equation. Y is equal to x squared. dy by dx becomes 2x. 2x is not a constant because the rate of change itself depends on the x. Everybody yes or no? No. So what happens is, we assume in our all calculation volatility to be constant. Suppose I say volatility is 3.791%. I mean that always it is going to be 3.79%. We assume the volatility to be constant. But really it is not 3.791%. It is 3.791% is volatility when the yield is how much percent? 10%. When the yield becomes 10.5 or 11%, the volatility will not be what? 3.791, because the volatility is not constant for the yield. The volatility still depends on what? Duration by 1 plus y. So by wrongly assuming the volatility to be constant, I presume that the price-yield relationship is linear, but really it is a curvilinear. So the difference between the real point and the actual and the point on the line is going to be called as convexity. Above that only we started our discussion. Everybody, are you following or not? Now, I'll continue further. Okay, shall I proceed? Now, last class I had drawn a diagram. There's a small mistake in the diagram regarding the line which I have drawn. I'll correct it and then proceed further. Okay, now. Okay, this is right. When the yield to maturity increases, the price of the bond decreases. When the yield to maturity decreases, the price of the bond increases. Respond. Are you all following up? Now, see. Assume this to be a straight line with a point of tangency. Okay. Suppose YTM is 10%. We are doing this. Someone I have copied the example now. Tell me. YTM 10%. What is the value of the bond? 1000. YTM 10% value of the bond? 1000. This is going to give you a much more better understanding of the convexity. Yesterday when I did not draw tangency. I just roughly draw a line. Just I want to give a much more clarity, that's all. Now, listen here. We are starting here. YTM is 10%. We found out the bond value to be what? 1000. This is a value I can arrive even by calculating the bond values. Can I proceed or not? Now, let us take an example. YTM is not 10. YTM is 8%. YTM how percent? 8%. I'll just write here YTM as 8%. Okay. Now, my bond value is going to increase or decrease. Answer my question. Increase or decrease? Increase. When the YTM reduces, the bond value increases. Now, let us calculate actually what will be the bond value by using the original valuation principle. What is the value of a bond? Present value of the future cash flows. We are now starting to discuss about convexity. Can I proceed? So what is the value of the bond? Present value of the future cash flows. So can we calculate or not? I will do it here itself. Now, we are having a bond year and then cash flow. Present value factor at what percent? 8%. And discounted cash flow. I want you all to help me in doing my calculation. Tell me, when you buy this bond, this is a how many years bond? We had an example last class or not? How many years bond? 5 years bond. I get for 1 to 5 years what? Coupon. How much percent coupon? 10%. The question gave 10% what value? Face value. What the coupon I get? 100. 5th year I get redemption. The redemption is at par. Nothing is said. Tell me what is annuity factor for 5 years 100 rupees. Tell me what is the annuity factor for 5 years 8%. How many days? 3.9927. 5th year present value factor is 0.680. Some number here, 0.6806, leave it, 5 or 6, not an issue. 100 into 3.9927 gives you what? 399.27. 1000 into 0.6 gives how much? 680.60. Can you tell me the total? The total is going to be, how much it is? 1%? 1%, 1000? Stop talking. What's happening here? I am not even able to hear numbers set from this side. Solupa. 1079 point or 1080 as a case 1079.87. This is the real value of the bond. I don't do any shortcuts. I say this is going to be the real value of the bond. Respond. Are you following or not? Now, I will also try to find out value using volatility. Using what? Volatility. Now, what is the volatility of this bond? Look at the notebook and tell me what the volatility 3.79%. Meaning of this, when YTM changes by 1%, the bond value inversely approximately changes by 3.791%. Now the YTM has changed from 10% to how much percent? 8%. The bond value will change by 2 into 7.7 as 3.791%. How much it is? 7.582%. Everybody accept or not? Now, I'll just do it alternatively. Okay. Now, the bond value, the price of the bond will decrease by, will increase, it'll increase by 2 into 3.791% is equal to how much here? 7.582%. 2%. Yes or no? Now, that means the bond value after the YTM change is 1000 into 107.582 percentage. Respond, yes or no? Is how much going to be? 1075.82. This is the bond value I get using what formula? Volatility formula. Yes or no? Now I have two bond values. The real bond value by discounting the bond cash flows and the bond value using what? Volatility formula. Tell me, are they same or different? This is around 1080 rupees. That is around 1076 or 1075 rupees. Everybody yes or no? Now the question is, sir, why the value is different? Because here I assume the volatility to be a constant. Is it a constant? It is only a function, okay, but we assume it to be constant. By assuming the volatility first derivative to be constant, I presume that the price bond relationship is what? Linear. So if it is 1000 here at 8%, I got this number 1075 point what? 87. Yes or no? At 8% I got how much? 1075.87. But the real bond value at 8% is what? 1080. If you look at this, I have one point here, I have another point here. This point is 1080 approximately. I call this point as 1076 approximately. Respond, yes or no? Why the 2 points are different? Really, the bond yield relationship is a curve, but we assumed by having the first derivative as a constant 3.79%, the bond yield relationship is what? Linear. It is not linear, it is a curve. In that case, the difference between the point on the curve and the point on what? The line is what we call as a convexity. Everybody yes or no? Right or not? Now, see, when you wear specs and all, they say concave lens, convex lens and all. School have done some lab test and all, no? Now convex lens. Okay, now, see, a glass is there, yeah? Okay. If the glass is flat, if the glass is what? Flat. The lens is what? Flat. What happens is, the distance what I see is a real distance, right or not? So I have a short sight or long sight, anything, a sight problem is there, okay. In that case, when it is what? A convex lens, what happens is, the distance what I am seeing from here to that bulb, really is not the distance, right or not? The real distance will be either longer or what? Shorter. Why? Yeah. I am not looking using my original eyes, I am just looking using what? The glass, which is convex. Are you following not? Right or not what I am saying? So, what is see through convexity and what is what? Naturally, there is going to be a linear and a convex side. Is going to change or not? The distance is going to obviously change. Same thing, and also what happens is, it is really a convex. It is really what? Convex. But what I see is what? A straight line, a plane relationship. Obviously, what I see is not the real value of the bond using the volatility. The volatility needs to be what? Adjusted. That adjustment factor only we call as what? Convexity. Right or not? Now tell me, convexity gives me the accurate value of the bond, right or not? To some extent. It will be giving only to some extent what? Accurate value. Why convexity also will not give you the accurate value of the bond? It is much more better than the mere volatility. It gives you a near accuracy. I don't think it gives you a near accuracy, but can never give you what? The accurate value of the bond. I'll tell you the reason during the Malkiel's theorem. Are you understand what I'm saying? When I have a volatility, I cannot believe in volatility straight away. The volatility should be adjusted for what? Convexity. And the convexity gives you a value which is nearer to what? The actual bond value. Now, here I say, volatility of 3.79% will be true for a small change in yield. For a small, if the yield change by 0.1% or 0.05%, in that case what happens is, I'll be moving here and here. I'll be nearer to the curve. From the tangent, I will be near the tangency. Tangency at 10%, both are giving the same value or not? Now, if it is 0.0001%, the bond value, the YTM changes, then the volatility will give me almost the same answer as what? The real value, because I am nearer to this particular curve when I am near to the tangency, yes or no? But when the yield changes very much, 2%, 3%, 4% and so on, in that case, I am on the straight line using volatility, but the curve moves away away from me. The curve moves what? Away from me. So longer the volatile, that is longer the interest rate change or bigger the interest rate change, more approximate will be what? The volatility way of finding out the bond price. Everybody, are you able to visualize or not? So the distance is greater means the volatility becomes a very, very approximate number only, because I am moving farther away from what? Tangency. When I move farther away from tangency, the gap between the real bond value and the bond value using volatility, which is linear, is going to widen and widen and widen. The approximation becomes much more bigger and bigger and bigger. Everybody following out? This is what I wanted to convey in this concept called as convexity. The remaining is only mathematical calculation. That's a calculation, that's all. But if you understand or visualize the concept of convexity or not? Now, just to simply put it, very simple. The bond price yield is a function. That is, price of a bond is equal to C1 by 1 plus y power 1 plus C2 by 1 plus y squared up to what? The last cash flow divided by 1 plus y power n. This is the price of the bond, where it is dependent on the denominator, yield to maturity. Point number 1, yes or no? If you find out the dp by dy, if I differentiate the price with respect to what? Yield, I know the rate of change in price for the yield change. Yes or no? That is what we call as the volatility. That volatility we derived as duration by 1 plus y. We derived by what? Duration by 1 plus y. Unfortunately, we called it as a volatility formula. The duration by 1 plus y, we call as what? Volatility formula. So if the y is 10% and the duration is 4.17 years, we call volatility as what? 3.791%. And we made that volatility, which is a function, into what? Constant, by saying 3.791%. Are you following what I'm saying? Now, how I have to decide is, when the yield is 10%, the volatility is what? 3.7991%. I am accepting it. I am not saying it is wrong. There is the first derivative, yes or no? But that volatility is true only for what? A small change in yield. Is true only for what? A small change in yield. Because when the yield change is much more bigger, the point of tangency shifts from here to what? Here. Everybody is on. The shift in the point of tangency is linear. Are you following? The shift in point of tangency is what? Linear. But the point of tangency is not always constant. Everybody, are you following what I am saying? In that case, since I assume the first derivative to be constant by saying 3.791%, but in fact the first derivative is what? A function, duration by 1 plus y. What happened is, there is always a difference between the point on this line and the point on this curve. Which is a correct point? Curve pointer, line pointer, curve point, because the yield price relationship is not linear. The real point lies on the curve, but the point which I calculate using volatility lies on what? Line. For an 8% YTM, the curve says the bond value is 1080. The line says the bond value is 1076. The 4 rupees difference is there or not? The difference we call as what? Convexity. It is trying to establish a relationship between the point on the line and the point on the curve. Everybody following on? And I said, if the yield change is very small, if the yield change is what? Very small, then the point on the line and the point on the curve will not be so huge difference. There will be almost what? Same. For a small change in yield, this volatility is a correct concept. But when the yield change becomes bigger, the volatility becomes much more approximate. Is what ultimately we have discussed here. Everybody following? Can I proceed further? No. So how to calculate this convexity? For that we have a procedure or formula. With that we will complete this concept called as convexity of bonds. See, convexity till now was not asked in the examination. Even immunization has not been asked in the examination. But not that we are discussing something extra, because convexity was mentioned in one of the RTP. Okay, they did not have a sum, but they mentioned about what? Convexity. That is why we are discussing elaborately about the convexity. What is looked into RTP generally comes into the examination, the later stages. That is why some time has been spent for understanding the concept of convexity of the bond. Everybody having the clarity? Always. I am very happy in teaching IFM and other chapters, because it is more general. Whenever I come to something little bit mathematics or statistics, I feel afraid, because people lose focus or interest. Inevitable in learning this subject with what? Mathematics or statistics. I try to explain as low as possible. That is down to earth. Even the mathematical concept I did not discuss straight away. I discussed what is a first derivative, how to calculate it. I also showed you the meaning of what? The first derivative, and then proved the volatility formula, and then showed you how that formula is for a is not a constant. The first derivative is not a constant but only a function, and how for linear the first derivative should be constant, how wrongly assuming it to be what? Constant makes us having the difference. All this I have explained. Now all this since I explained, I want a confirmation. Did you all understand? If not, last class, last 45 minutes, and this class next 30 minutes would have become what? Waste. I hope you all have understood or not. Now, I'll dictate the notes for this once we complete the convexity. Can I start calculating convexity or not? Now, let's go for the convexity calculation. Please. Stop talking. Request. Okay. See, just for you to visualize, this is not required, just for you to visualize, I just add some YTMs and also the bond value. Bond value actual means value in the line, in the curve. That is found out using actually discounting the cash flows. And bond value using duration formula will be on the line or on the curve, on the line. Respond, accept or not? Now, see, 10% YTM. Actual bond value is 1000, and the bond value in the line is also what? 1000. That is the point of tangency. YTM decreases to 8%. You calculated, tell me what is the actual bond value? 1080. And you only calculated volatility bond value is how much? 1075.82. Something you calculated, respond, yes or no? No. Like that, you believe me, I put for 6%, I have put for 4%. Like that, I put for 12%. 14% and then 16%. Everybody yes or no? That means this is the center, that is 10%. The yield decreases. See, the bond price increases. 10%. Red boxes are all yield increasing. When the yield increases, the bond price are all decreasing. Ennappa, right or not? Now, if you see, what happens is the gap slowly widens, yes or no? Because 1075, 1080, then becomes 1151, 1168, 1227, 1267, 924, 928, 948, 848, 863, 772, 804. Always the real point, and this is the real point, that is actual bond value, and the bond value using duration formula, the value becomes broader and broader as I just go away from what? The tangency, 10% yield to maturity. Respond yes or no? The problem is, sir, how to bridge the gap between this 1080 and what? 1075, 1168 and 1148. For this, you have to calculate what? Convexity. You have to calculate the convexity. Now, instead of writing the formula for convexity, which you may not understand, I will do it with the calculation. I will put the formula. Everybody can I put it or not? No. Even if you remember the calculation, enough. The formula only is nothing but the calculation. Can you start or not? Now, all of you participate. We can by heart this calculation. I am not going to derive this because something beyond our requirement for this derivation. I wouldn't have derived the volatility itself. I did not derive because I know it. Understood? Because I only tell whatever is useful for you or convenient for you. I am forced to derive volatility to understand the convexity. Are you following or not? Now, convexity, let's understand the calculations enough. Okay. These are all the column numbers, so don't get confused. So, T, cash flow, present value factor, discounted cash flow. T means years. Okay, how many year bond? All of you participate? 5 years. Tell me the T, 1, 2, 3, 4 and then 5. Cash flow. Every year the bond gives you a coupon. How much percent coupon? 10%. For what face value? 1000. Tell me the coupon? 100, 100, 100 and then 1100. Last year coupon and what? Redemption. Present value factor, yield to maturity. Always discount using what? YTM. What is the YTM of the bond? 10%. Now even child knows what the present value factor for 10% 1 year. 0.9091, 2 years. 0.8264, 0.7513, 0.626830, 0.6209. Discounted cash flow is 90.91, 82.64, 75.13, 68.30 and 683. 1100 into 0.6209 gives you 683. Multiplied and checked or not? No. If I total this, the total should be how much? 1000. Can I check it or not? Here or there, point difference limit is totaling to approximately what? 1000. Okay. Now, next I am going to write t into t plus 1. I have to find out what? T into t plus 1. What is t? What is t plus 1? 1 plus 1 is 2. 1 into 2 is what? 2. Now, can you tell me for next, what into what? 2 into 3. Next is 2 into 3 gives you 6. Next is what? 3 into 4, 12. 4 into 5, 20. 5 into 6, 30. This is what we call as t into t plus 1. It is forming part of convexity calculation. Can I proceed or not? No. Next is 4 into 5. Column 4 into 5. Discounted cash flow into t plus 1. Tell me it is 90.91 into 2. 82.64 into 6, 75.13 into 12, 68.30 into 20, 683 into 30. If I total, I'll be getting 23,435. 23,435. Respond, are you all following or not? Okay. How they given the formula technically is, we have found out a number. Tell me what is the number? That number is what? 23,435. How they write in different books is as follows. Notation. Sigma I is equal to 1 to t. T into t plus 1 into discounted cash flow for t. Okay, this is a formula. What the formula? Sigma I is equal to 1 to t, t into t plus 1, discounted cash flow for t. Very simple here. T I means I can be 1, it can be 2, up to how much here? 5. So all I have to sigma means what? Total. 1 into 1 plus 1 is what? 2. Discounted cash flow for year 1 is what? 90.91. That we keep that. That is one number. Plus. Next is what? I becomes 2. Then 2 into 2 plus 1 is what? 3. Discounted cash flow for year 2 we have. Multiply. Keep that. Like that. Write it up to what? 5. Sigma means what? Added. This is how the notation is written. Everybody able to understand the notation or not? Somewhere in the RTP or anywhere you come across notation. Don't think we have done something different. That only simplified into table. How to easily remember and do it. Everybody following not? Now. This is number 1. Okay. Now, this is one term or not? This into 1 by P. The word P means what? Price. Into 1 by 1 plus Y the whole square. Y means what? YTM. This is going to give you a number called as convexity. We get a number called as what? Convexity. The formula for convexity is 1 by P into 1 by 1 plus Y square into this particular term is going to give you the formula for convexity. Everybody, can I proceed or not? No. That's what I'm going to do here. Can I proceed? No. 1 by P. What is 1 by P? 1 by 1000. Now P is 1000 or not? Bond price into 1 by yield to maturity is how much percent? 10%. 1 by 1.10. 1 by 1 plus Y. The whole square. Yes or no? Into this number is nothing but sigma I is equal to 1 to T. T into T plus 1. Discounted cash flow for T. That number has been calculated. If I do all this, I get the convexity as how much here? 19.36. What is convexity? 19.36. Up to this, everybody, are you following the calculation or not? No, by heart. Tell me the columns. First column is what? T. Second column is cash flow, present value factor, discounted cash flow, T into T plus 1. T into T plus 1 into discounted cash flow. The total have it in hand, that is one number. Yes or no? Then that number should be multiplied by what? 1 by P into 1 by 1 plus Y square. That gives you what? The convexity number. Respond up to this. Are you following or not? No. Now I have to find out the real price of the bond. I have to find out what? The real price of the bond. This is how we should be finding out now. Percentage change in bond price. That's what I have to find out now. When yield changes, how much percentage of bond price changes? The formula is percentage change in bond price is Volatility into change in YTM I've been already doing, yes or no? Change, that is volatility is 3.71 and the YTM change suppose is 4% from 10 it has become what? 6. For example, yeah, 10 it became what? 6 now. YTM change 4% means the bond price will change by 3.71 times of what? 4%. That is yes or no? Now, this is what we have been doing till now in the bond chapter, and this percentage is said to be very approximate. It can be what? Approximate and not accurate. Yes or no? This approximate change should be adjusted for more accuracy or not. How it is adjusted here? Half into convexity into change in YTM squared. Half into convexity into change in YTM squared. Can I put the number up? Now, please tell me the number. For example, I am going to change it by 4%. How much percentage here? 4%. See, percentage change is 3.791 is what? Volatility into what is change in YTM? 0.04. Now 4% YTM change, 4% is 4 by 100. Accepted? Huh? So 4 by 100 means what? 0.04. So 3.791 into 0.04 is a normal volatility, yes or no? Plus half into what was your convexity? 19.26 into YTM change is what? 0.04 the whole square. If I simplify, I'll be getting how much percent? 16.71%. How much percent? 16.71%. That means and YTM changes by how much percent? 4%. The bond price changes by 16.71%. Am I right or not? Okay, so when the YTM changes by 4%, the bond price changes by 16.71%. Now, our current YTM is how much percent? 10%. It drops how much percent? 6%. Isn't it correct? It drops how much percent? 6%. What should be the bond price here? It is going to be 1000 into the bond value increases or decreases? Increases into 116.71. The base value is 100, goes up by what? 16.71. What the bond price? 1167. Enough for right or not? Now, please, this is for the 6% YTM. Now, let us go to the previous table which I had. At 6% YTM, the real bond value is what? 1168. I got a number 1167, which is very, very better than the 1151 what I got using the simple volatility formula. Are you all following what I am saying? Everybody, yes or no? No. So this convexity makes my bond price move closer to the real bond price. I cannot guarantee 100% accuracy. The reason I will discuss through Malkiel theorem. He has made some observations. All are empirical proofs. At that stage, I will tell you. But it will be much more better than what? The volatility, what you have calculated. Are you following or not? Now, tell me, number one. What is percentage change in bond price? Formula. Percentage change in bond price is equal to what? Volatility into percentage change in yield. This is basic, yes or no? Plus, any adjustment? Yes, all adjustment. Half into convexity into yield square. Percentage change in yield square. He is going to give me the convex, is going to give me the real change in bond price. Everybody, are you following or not? With this, we complete our discussion regarding the convexity. Nothing great we have to discuss. Just we discussed two formulas now. Tell me first. What is the formula for convexity? Tell me. Sigma I is equal to 1 to T. Inside that what? T into T plus 1 into discounted cash flow for T into 1 by P into 1 by 1 plus Y squared. He is going to give me the convexity. And how is going to be used here? Percentage change in bond price. All of you, percentage change in bond price is equal to what? Volatility into percentage change in yield to maturity plus half into convexity into percentage change in yield to maturity will give it half percentage change in yield to maturity squared. Okay, he is going to give me the percentage change in the bond price. This percentage will bring my bond price almost nearer to what the real bond price is, what I tried to say now. Everybody, are you following or not? With this, we complete this particular convexity concept. Can I proceed? Now, in the notebook, I think you have written up to this example number 8. What do is, this is not required, but just write it, just for you to understand how the price actual and the duration formula price is going to be very different. And then we can just go for the convexity, finally the notes. Okay, please copy this quickly. Stop talking, please. Stop talking. So you should have written that example in the previous class. We are continuing with that example. Please copy this. For the bond mentioned in the example, for different YTM, these are all the actual values and those are all the values as per the duration formula. Finish coming on. Stop talking. That 10% you block it, that is a base point, tangency. The blue boxes shows the decrease in YTM impact, red boxes shows the increase. You can make them into two blocks, okay, one for decrease, another for increase. Stop talking. Those not copy, raise your hand. Shall I proceed above? Now, see. Let us do the full copy and then start writing the notes. Please. Stop talking, please. Have you all finished copying? Please. Should I the last line? So convexity is equal to 1 by 1000 into 1 by 1.10 squared into 23,435, 19.36. Those who have not copied, please raise your hand. Okay, fast. Finished? Please, shall I proceed? Percentage change in bond price. I will dictate right along with me. Percentage change in bond price. Percentage change is equal to volatility into change in YTM. Volatility into change in YTM plus half into convexity into change in YTM squared. Volatility into change in YTM plus half into convexity into change in YTM squared. Change in YTM squared. Percentage change is equal to 3.791 into, what is 3.791? Volatility. I just took an example into 0.04. I felt that the bond price changes by 4%. Yield changes by 4%. 3.791 into 0.04 plus half into 19.26 into half into 19.26 into 0.04 squared. Half into 19.26 into 0.04 squared is equal to, how much you are getting? 16.71%. Is equal to 16.71%. Bond value when YTM decreases by 4%. BV means bond value here. Bond value when YTM decreases by 4%. Bond value when YTM decreases by 4% is equal to 1000 into 116.71%. 1000 into 116.71% is equal to 1167. Is equal to 11 number 19 point. Okay, 36 but calculation right okay, make a change 19.36. I think it is 19.36 now. So half into 19.36 into 0.04 squared. Calculation right or not? Okay. Shall I proceed further? No. With this, we calculated the convexity of the bond. Stop talking, please. Can I proceed? Now. I will give you notes because one more point I have to discuss, which can be understood through Malkiel's theorem, and then give you a comprehensive note for whatever has been discussed. Can I proceed? Now. Let's go to the last concept called as Malkiel's theorem. Okay, please, just observations only regarding the bond features or characteristics. Okay, see. We have not discussed anything great today. We calculated convexity and understood what it is through the diagram. That's all. Right or not? Now, these are all the things. Some of it is already known to you. Some will be observed now regarding the bond concepts or bond features. No need to copy. First participate. Bond value and YTM are inversely related. This is what Malkiel said regarding the bond instruments. Okay, this is known to you or not? Yes. When the YTM increases, the bond value decreases. When the YTM decreases, the bond value increases. Is the first observation made? Yes or no? Bond value and YTM are inversely related. Number 2. Long-term bonds have more interest rate risk or volatility. Now, there is a 2-year bond, there is a 7-year bond. There is a 2-year bond, there is a 7-year bond. Which will have more volatility? 7-year bond. Because more longer the bond's maturity, bigger will be its duration. Formula, a 10-year bond will be having more duration than a 2-year bond. Yes or no? A 2-year bond cannot have duration more than 2 years. If it should be 2 years, it should be a zero coupon bond or not. In that case, a 10-year bond will be having more duration than what? A 2-year bond. Duration is in the numerator, no duration, but 1 plus y is what? Volatility. When duration becomes bigger, the volatility is what? Much more higher. That means in the bond market, there is a 25-year Government of India bond trading. There is a 10-year bond Government of India bond trading. Tell me which bond is more risky? A 25-year bond or 10-year bond? Why 25-year bond? A small change in the interest rate by RBI will make that bond price fluctuate very widely because long-term bonds are more volatile than a short-term bond. Everybody yes or no? A money market instrument, that is the instrument within what? 1 year will have very, very less volatility. Everybody, are you following what I am saying? So, volatility is more as a term of the bond increases. In the second observation, everybody following or not? Now, don't discount anything. All this may be also as what? Exam question. Can I say? Now, point number 3. Price sensitivity increases with maturity but increases at decreasing rate. Now, answer me. 10-year bond, 25-year bond. Which bond is more sensitive? 25-year bond. To yield change, which price is more sensitive? 25-year bond. 25-year bond volatility is more than what? 10-year bond. Yes or no? No. But as the maturity increases, accepted volatility increases. But the volatility increases at a decreasing rate. Are you following? Now, in other words, say for example, 4-year bond volatility is 3%. Same bond, coupons, OITM, everything same. 4-year bond, suppose volatility is 3%. 6-year bond, 8 years bond, don't say volatility is 6%. The volatility will be more than what? 3%. No denying that. It will not be what? 6%. The volatility increases at what rate? Decreasing rate is what Malkiel said. Yes or no? All this they will prove by taking different bonds. If you take CFA study metal and all, they'll be having lot of columns, a 3-year bond, 4-year bond, 5-year bond, 6-year bond. All the bonds, they calculate all this to prove this particular Malkiel theorem. Are you following what I'm saying? I'm giving only the conclusion for you. Can I proceed further? No. So tell me, the volatility, the price sensitive means volatility. The meaning is what? Volatility. Volatility increases with what? Maturity. But the increase at what rate? Decreasing rate. Is the next observation. Can I proceed or not? No. Next. Low coupon bonds have high interest rate risk. Interest risk is volatility. When the interest rate changes, bond price changes or not. That is called as interest rate risk. What is risk? When something is not at all volatile, steady now what? No risk. More volatile means what? Risk. Low coupon bonds are having high volatility and high coupon bonds have got what? Low volatility. I'll give an example. See, I have a 5-year bond. One is a zero coupon bond, another is a coupon paying bond. What is the duration of a zero coupon bond? 5 years. What about a coupon paying bond? Less than. That means zero coupon bond has the highest duration. Coupon paying bond having what? Lower duration. So no. When the duration is higher, volatility is what? Higher. When the duration is lower, volatility is what? Lower. Accept or not? Upper zero coupon bond is having the highest duration. Low coupon bond is having what? High duration. And high coupon bonds having what? Low duration. And the volatility also is going to be obviously the same way it is going to move. Are you following what I am saying? In that case, what they say is low coupon bonds have got high interest rate risk. That is volatility. Everybody following or not? So now in all this, they are linking the bond to the volatility except for the first point. First point what they said, bond price and yield are having what? Inverse relationship. Number 2, long-term bond is that, short-term bond is that. 25-year bond, 10-year bond. Which is the highest volatility? 25-year bond. Long-term bonds have got more risk, high volatility. Next is volatility increases as the bond term increases not. But the increase is at what rate? Decreasing rate. The price sensitivity means what? Volatility increases with maturity at what rate? Decreasing rate. Next, high coupon bonds, low volatility. Low coupon bonds, high volatility. Zero coupon bond, highest volatility. Yes or no what I am saying? In that case, the risk of the bond, low coupon bonds are having more risk and high coupon bonds are having less risk. The reason very simple, yeah, you receive the money earlier. But for other bond, you have to receive till the last year. Okay, in that case, you never got a reinvestment opportunity for a zero coupon bond. Everybody follow what I'm saying? That you have for what? Other bonds. So low coupon bonds have got high risk. And finally, this is the important point for which I discussed. Volatility of the bond is not symmetrical. Very important. Volatility of the bond is not symmetrical. Now, I'll ask you one thing. When YTM increases, what happens to bond price? YTM increases, capital loss. Why capital loss? Bond price decreases. When YTM decreases, what bond price? That's a capital gain. When the yield drops, that's a capital gain for the bondholder. When the yield increases, there's going to be what? A capital loss for bondholder? No. Now, see here in this particular observation, I'll come back to this. Take two numbers here. Don't take this duration formula, it is approximate. Don't look at the actual. 10% YTM, what the bond value? Suppose it decreases by 2%, capital gain or loss? Gain. How much capital gain? 80. It increases by 2%, capital gain or capital loss? Capital loss. What the capital loss here? 72. That means the capital gain is not equal to capital loss. Are you follow what I am saying? That is, what gain I make due to yield decrease will always be more than what loss I suffer due to what? Yield increase. Because the volatility is not symmetrical. It's not what? Symmetrical. Symmetrical means what? Same both sides. It's going to be same what? Both sides. Symmetry means same both sides. It's asymmetrical because the capital gain always which I make due to the yield change will be always more than what? The capital loss which I suffer due to the yield change. Everybody has to know 2% yield change gives me a capital gain of 80. The same 2% yield change gives me a capital loss of only how much? 72. So it is not symmetrical. It's going to be what? Asymmetrical. That is why convexity 2 cannot give me what? Right answer, because even if I adjust for the convexity, there also as an asymmetry happens, that is acting against me. Are you follow what I am saying? So the real bond price can be calculated only by actually discounting it. Yes or no? The volatility gives you very approximate, the convexity takes you nearer to it, but nobody can tell you the actual because the convexity 2 is what? Asymmetrical and not symmetrical. Everybody, are you following what I am saying? That is why I said convexity gives you what? Not the accurate value, but a near accurate value. Everybody, are you following or not? Now, this is the last point Malkiel said. So the last point is what? Volatility of the bond is not symmetrical. Decrease in interest rate increases the bond value more than the decrease in bond value due to the increase in interest rate. That is always the capital gain is going to be more than what? Capital loss. That makes bond holding investment somewhat advantageous because if the interest rate volatility is that, but always the favor is more than what is against you. Everybody, are you following what I am saying? So this is regarding the bond issues. With this we have completed all the core areas in the bond valuation. Concepts are all covered. Two miscellaneous problems are left out. In the last problem, I'll move on to the equity valuation through that particular sum. Everybody having the clarity or not? Now, these are all the 5 important features Malkiel said about bond. I'll just say in CFA study material, what they do is for every point, they just what? Show the empirical proof, not mathematical proof. They take what 8 or 10 bonds and show how it is asymmetrical, how they are going to be one symmetrical and so on. Nothing great. That material you also can prepare. Take 5 or 6 bonds. Okay, 10%, 12%, 13, 14, 15. Try to prove all the points. You are getting much more clarity. Can I give that as homework or not? Put the summary okay. Anybody done question number 16 and forward rates? I will complete it or not? Now. So you can just try, if you have any time, instead of watching cricket match, test match and all, you can just try out how the bond price reacts to what the various yield change one can see. Okay, now, shall I proceed? Now, please copy this Malkiel's theorem. Copy this Malkiel's theorem. Copy this as quickly as possible before you go for the notes. Okay. I will dictate, okay, Malkiel's theorem. Point number 1. Bond value and YTM are inversely related. Bond value and YTM are inversely related. Point number 2. long-term bonds. Point number 2, long-term bonds have more interest rate risk. Long-term bonds have more interest rate risk, that is volatility. The word interest rate risk means what? Volatility. How much the price moves due to the interest rate movement. So long-term bonds have more interest rate risk, right? Volatility. Point number 3. The price sensitivity increases. The price sensitivity increases. Stop writing and tell me what is the other name for price sensitivity? Volatility. Okay, the sensitivity of the price regarding the yield. Because volatility, the price sensitivity increases with maturity. The price sensitivity increases with maturity, but increases at decreasing rate. But increases at decreasing rate. But increases at decreasing rate. Point number 4. Low coupon bonds have. Point number 4. Low coupon bonds have high interest rate risk. Low coupon bonds have high interest rate risk. That is volatility. What other name for interest rate risk? Volatility. Low coupon bonds have high interest rate risk. That is volatility. Point number 5. Volatility of a bond is not symmetrical. Volatility of the bond is not symmetrical. Volatility of the bond is not symmetrical. That is, decrease in interest rate increases. That is, decrease in interest rate increases the bond value. Decrease in interest rate increases the bond value more than the decrease in bond value, more than the decrease in bond value due to increase in interest rate. More than the decrease in bond value due to increase in interest rate. Due to increase in interest rate. That is, CG means what? Capital gain greater than capital loss. That is, capital gain greater than capital loss. For this, right? For example, continue writing. For example, when YTM decreases, for example, when YTM decreases from, what to what? 10% to 8%. When YTM decreases from 10% to 8%, the bond value increases by, how much rupees? 80 rupees. The bond value increases by 80 rupees. That is, capital gains is equal to rupees 80. That is, capital gains is equal to rupees 80. Full stop. On the other hand, when YTM increases to 12%, when YTM increases to 12%, the decrease in bond value is just, tell me how much rupees? 72. The decrease in bond value is just 72. Thus, capital gain greater than capital loss. Thus, capital gain greater than capital loss. Capital gain greater than capital loss. Everybody, are you comfortable or not? No. With this, we have also done the Malkiel's theorem. Can I write a small notes for convexity or not? Let's write the notes and then complete that. Write down notes. Notes. Point number 1. Point number 1. Please copy this particular diagram. Point number 1. Copy this diagram. We have x-axis, we have YTM. In y-axis, we have price. In x-axis, we have YTM. In y-axis, we have price. Please draw a curve and draw a tangency line. Draw a curve and draw a tangency line. You have finished drawing it, huh? Just draw it here. It was curve and line like this. That's all. Okay. Now, point of tangency, mark it and join downwards. That is 10% YTM. Point of tangency called as 10% YTM. And price, make it as how much rupees? 1000. YTM 10%, price is 1000. Now, I decrease my YTM to how much percent? 8%. YTM 8%. What is the point on the line? 1075 point something we had, around after 1076. Accepted on 1076. 8% 1076. Same 8%. What is the point on the curve? 1080. Same 8%. The point on the curve is 1080. Points on the curve is 1080. Everybody, can I proceed or not? This is point number 1. Just to understand the diagram. Can I proceed? Point number 2. Point number 2. In our example, for each YTM, we calculated. In our example, for each YTM, we calculated bond values in 2 ways. In our example, for each YTM, we calculated the bond values in 2 ways. We calculated the bond values in 2 ways. Branch it into 2. Branch it into 2. First branch, the actual value using the discounting technique. First branch, the actual value using the discounting technique. The actual value using the discounting technique. Second branch, the value using the volatility formula. The value using the volatility formula. Some books say using duration formula because they say duration means volatility. Modified duration is called as what? Volatility. We discussed in one of the some or not? Now, the other name for volatility is modified duration. For duration, what is the other name? Maculus duration. Remember or not? So, using the volatility formula. Now, point number 2 or 3 or 3. For example, value of bond at 8% YTM is, for example, value of the bond at 8% YTM is, have the following columns: year, cash flow, present value factor at 8%, discounted cash flow. Year cash flow, PVF at 8%, discounted cash flow. Year 1 to 5, 5. Year 1 to 5 and then 5. 100,000. Cash flows are 100 and then 1,000. 5 years coupon 100, 5th year the price is, or redemption is 1,000. Annuity factor 3.9927. 0.6806, 3.9927.6806. Discounted cash flow 399.27, 680.60. 399.27, 680.60. 1079.87. 1079.87. That's all written as what? 1080 or 1080 or 1080. Alternatively, increase in price is equal to, or percentage increase in price is equal to, percentage increase in price is equal to 2 into, why 2? 2% YTM, no? So 2 into, what the volatility? 3.791. 2 into 3.791 is equal to how much percentage? 7.582 percentage. 2 into 3.791 is equal to 7.582 percentage. Bond value is equal to 1000 into 107.582%. Bond value is equal to 1000 into 107.582% is equal to how much? 1075.82 is equal to 1075.82, or how much is 1076 or 1076. Everybody, are you all following the numbers or not? No. Don't think that I am dictating once again everything. It will be very helpful during the revision process later. Can you say point number 2 or 3 or 4? Point number 4. Point number 4. If original function is linear, if the original function is linear, then, don't talk, then its first derivative, if original function is linear, then its first derivative will be, tell me, it will be what? Constant. If original function is linear, its first derivative will be constant. If first derivative will be constant. For example, y is equal to 3x plus 4. For example, okay, y is equal to 3x plus 4 is linear. For example, y is equal to 3x plus 4 is linear. Hence, dy by dx is equal to 3. Hence, dy by dx is equal to 3. dy by dx is equal to 3 is a constant. dy by dx is equal to 3 is a constant. Which means, always when x changes by 1, the y changes by 2. Always when x changes by 1, the y changes by 3. Okay, always when x changes by 1, the y changes by 3. Can you proceed or not? Full stop. Continue. If the original function is y is equal to x squared. If the original function is y is equal to x squared, bracket la non-linear, linear not to the power 1, right? Non-linear, bracket close. Then dy by dx is equal to, what? 2x, which is not a constant. dy by dx is equal to 2x, which is not a constant. dy by dx is equal to 2x, which is not a constant. Everybody saw no? Now 2x is having x variable now, it is not a constant. Continue. The volatility really is not a constant. The volatility really is not a constant. Bracket la, what the formula? D by 1 plus y. the volatility really is not a constant. Bracket write what? D by 1 plus y. And the volatility we have y there or not? So D by 1 plus y. But by assuming it to be constant, we are treating the price yield relationship. By assuming it to be constant, we are treating the price yield relationship. To be what? Linear. By assuming it to be constant, we are treating the price yield relationship to be linear. But in fact, it is a curve. That is why the actual bond value for 8% YTM, of rupees 1080, the actual bond value at 8% YTM of rupees 1080 lies on the curve, and the value derived using volatility lies on the straight line. The difference between these two values are adjusted using what concept? Convexity concept. The difference between these two values are adjusted using the convexity concept. Last point. Point number 3 or 4 or 5? Point number 5. Convexity is equal to, please write the formula now. We are not done formal formula now. Convexity is equal to, I'll write once again here. Convexity is equal to 1 by P, 1 by price, into what? 1 by 1 plus y the whole square. That y means what? Yield to maturity, into sigma I is equal to 1 to t. Inside the term what to be written? T into t plus 1 into discounted cash flow for t. Into t plus 1 into discounted cash flow for t. Can I say last? Percentage change in price is equal to tell me the formula, volatility into percentage change in YTM, or just simply change in YTM. YTM is percentage, no? Just simply write what? Volatility into change in YTM plus what? Half into convexity into change in YTM the whole square. Half into convexity into change in YTM the whole square. Half into convexity into change in YTM the whole square. Can I proceed? Last point. Point number 5 or 6 or 6. Convexity also will give near accurate value because convexity also will give near accurate value because convexity also gives near accurate value because the volatility is asymmetrical. Convexity also gives near accurate value because the volatility is asymmetrical. because the volatility is asymmetrical or not symmetrical. The volatility is not symmetrical. Bracket refer 0.5 Malkiel. In bracket write refer 0.5 Malkiel's theorem. Refer 0.5 Malkiel's theorem. Everybody up to this, are you following now? With this we have completed. What I have to give is the proof for the volatility and IFM dealer's text. Okay, now almost you have completed this chapter, bond valuation, except for two miscellaneous sum. In the last sum will lead to the share valuation. Everybody, are you following or not? Now, okay. It's an exam problem. Please stop talking. Workbook question number 29 above. MP Limited, which is sum? 29. Make the sum as 29. Please. Okay. Stop talking. So, today's class, what we discussed may be a little bit difficult. It continue with the last class. No need to worry. Now we'll move on to the normal concepts, which is understandable to us. Can I say? So come back to this question number 29, an examination problem. Okay, see. MP Limited issued a new series of bonds on January 1, 2000. Stop talking. The bonds were sold at par, having a coupon rate of 10% and mature on 31st December 2015. Coupon payments are made semi-annually on June 30th and December 31st. Assume that you purchase an outstanding MP Limited bond on 1st March 2008 when the going interest rate is 12%. What was the YTM of MP Limited bond as on January 1, 2000? What amount you should pay to complete the transaction? Of that amount, how much would represent bond basic value and how much would represent the accrued interest is the question. Now, nothing new we are going to learn in this question except for a small calculation that is also an IPCC calculation only. Apart from that, everything is known to you. Please apply your mind, read the question before you start with the solution. Don't waste time and try to understand and see what the question is all about, and let us start answering the question quickly. Finished now? Okay, let's start with the solution. Good morning, friends. Good morning, sir. Those who understood convexity, raise your hand. Okay, I believe. Can I proceed? Now. Others, those who not understood, leave it as a bad dream and come to the fresh problem. Wake up. Can I proceed or not? Now. Now. See, the bond was issued on which date? 1st January 2000. At that time it was selling at par. At how much rupees? 1000. The coupon of the bond is 10%. Now the first question is, what was the YTM of MP Limited bond on January 1, 2000? Tell me, at the time it was issued at par of 1000 rupees. What was the YTM? Why 10%? YTM is equal to coupon rate when the bond is issued at par and redeemed at par. When the bond is trading at par, it is trading at a YTM of coupon rate. Respond yes or no. So first question you need not calculate. One can straight away say the answer. Right or not? Write on first part 1. Write on part 1. Please all of you. YTM of the bond as on 1/1/2000. Part 1. YTM of the bond as on 1/1/2000. YTM of the bond as on 1/1/2000. Can I proceed? No. Write down. The YTM of the bond as on 1/1/2000 is, the YTM of the bond on 1/1/2000 is, the YTM of the bond on 1st January 2000 is 10%. Is 10%. That is same as coupon rate. Is 10%. That is same as coupon rate. Because, same as coupon rate. Because, why? The bond is selling at par value. Because the bond is selling at par value. Next, selling at means trading at. The meaning of selling here is what? Trading. So the bond is bought and sold at par value. That's what I meant. The bond is selling at par value. The bond is selling at par value. Point number 1. Everybody accept or not? No. Next. This bond is maturing on which date? 31st December 2015. The bond pays coupon every year or every 6 months. It is a semi-annual coupon paying bond. Now, I am now going to buy this bond on which date? 1st March 2008. Now, the today's date is 1st March 2008. I am going to go to the market and buy this particular bond. At this date, the bonds are trading at an YTM how much percent? 12%. Now tell me, what price I will pay? The value of the bond. What is the value of the bond here? Present value of the future cash flows. Whatever cash flow I am going to get from the bond after what? 2008, I will discount at what percent? 12%, and then find out the value. That's the price of the bond. Second point, everybody yes or no? One simple question is, the price of the bond should be more than 1000 or less than 1000? Why should it be less than 1000? You know, the market wants 12%. The bond gives only 10%. They can make the balance money only by paying less and redeeming at par. So they have to make a capital gain or not. So they'll be willing to pay only less price for the bond, giving a lower coupon. Everybody, are you following or not? You know, yes or no? No. No, we should discount annually or semi-annually or semi-annually. Should do this problem in years or periods? Up to this, are you following? No. See, I'll tell one small difficulty here and see how to overcome this. Now, I'm in which date? Okay, see. This is 1st March 2008, I'm here, right or not? Please. And the last date is what? 31st December 2015. Yes or no? No. Today if I buy the bond, in another 4 months, another what months here? 4 months. That is what? 30th June 2008. I'll be getting the first two coupon. Ennappa, right or not? Then all the remaining coupons happens in what? 6 months gap. Happens in what? 6 months gap. Now, I cannot convert into periods in this stage because most of them are 6 months. In between I have also what? 4 months. That's a problem for me. Ennappa, right or not? You understand or not? Suppose this is not March. This happened to be what? January. I am not at all worried. I'm not about worried because it's going to be what? 6 months always. Okay. Now, these cash flows occurs in total how many months here? 6 months. But earlier this problem comes in what? 4 months. This is an odd man out, right or not? So what I do is, first of all, I am going to assume this as ES0. I'm going to assume what? This as ES0. Are you following what I'm saying? Now, then I'm going to get the first two coupon on what date? 31st December 2008. This I call as what? Coupon number 1. This I call as what? Coupon number 1. For this, if I discount, I get the bond value here. It or not? Because from here on it's going to be what? 6 months interval. I discount the coupons, I get the bond value here. It or not? This bond value plus this coupon, if I add, can it be added or not? Yes. This is also on this date. The coupon also occurs on what? 30th June. If I add these two, I'll be getting the bond value on 30th June, which I discount by what? 4 months. I get the bond price today. Everybody following? Should I repeat? I repeat once again. See, what happens is, I receive my first coupon after 4 months. Kadaba? Second coupon onwards, still the last coupon, I receive in the interval of how many months? In that case, forget the first coupon. Forget what? First coupon. Suppose I am going to buy the bond on 30th June 2008 or 1st July 2008. Accepted? Suppose you forget this, I am not going to buy on March, I am going to buy on what? 1st July. If I buy the bond on 1st July, the first coupon comes in what? 31st December. Next coupon on what? Next to June, and so on. So from here, I have coupons in the interval of 6 months or not. The present value of these future coupons in the period of what? 6 months, if I calculate, I get the bond value on 1st July. Right or not? 1st July bond value can be added with, I get a coupon this or not. I'll be getting what? A coupon on 30th June. 30th June coupon and 1st July bond value can be added or not. Same time I'll have yes or no. Now, when I add, I get the bond value as on what? 30th June. That will discount me how many months? 4 months. I get the bond value today is a procedure number 1. Are you following not? More questions are asked. We'll discuss it in the next session. Please tell me, are you following? Now, let me start doing the solution. See, first I am going to find out bond value on 1st March or 1st July. I'm going to find out bond value on what? 1st July. Bond value on 1st July. Why not on 1st March? Because 1st March is an odd date. You know, 1st March to the first coupon is only how many months? 4 months. But from 1st July onwards, the coupon comes in what? 6 months time gap. Are you following what I'm saying? So, forget that you are buying on 1st March. You are buying the bond on what? 1st July. Like that, can you assume or not? Okay. Now, tell me, 1st July means how many periods are there from 1st July to 31st December 2015? Very simple here. In 2008, I received one coupon. Yes or no? Which coupon I received on 2008? 31st December. Participate. Yes or no? If you are not following, raise your hand and ask me to repeat here. Please. Are you all following? Yes, should I repeat or can I proceed? Gavani, alertness. Okay. Now, first two coupon when I receive 31st December. One coupon I received in 2008. 2009, 2010, 11, 12, 13, 14, 15. How many years? 7 years. I receive how many coupons? 14 coupons. Plus this one gives you what? 15. I should discount it for 15 periods. Right or not? Can I proceed further? Now, please participate. I'll just give you time to copy later. Period, cash flow, 1 to 15, 50. In a coupon is 10% per annum. How much percent per period? 5%. 5% should be applied on what? The face value of 1000. It should be 50. 15 period, I'll be getting a redemption of 1000. Discounted what percent? 6%. 12% YTM per annum. And what is per period? 6%. This is going to be the annuity factor for 15 years. Present value factor for 15th year. If I discount it, I'll be getting the bond price as 902.91. Accept or not? This is the price I will pay for the bond. If I buy the bond on which date? 1st July. 1st July morning when I buy the bond, I pay how much price? 902.91. Now, suppose I don't buy on 1st July, I buy on previous day. What is previous day? 30th June. Will I pay this price or more? More. Because on 30th June, I'll get one more 50 coupon. Yes or no? That means, very simple. Value on 30th June is going to be 902.91 is a 1st July value. Yes or no? When I buy on 1st July, I buy a X interest bond. Yes or no? But when I buy on 30th June, just a previous day, just 10 hours back, if I buy what? A come interest bond. So that means I have to pay price not only for the future coupons, also for what? The current day coupon, how much to pay? 50. I'll be willing to pay how much price for that bond? 952.91. Yes or no? Now, this is the money I will pay if I buy the bond on which date? 30th June. I am buying on 30th June or 1st March, 1st March. March to June, how many months? March, April, May, June. 4 months. So I should discount this by how many months? 4 months to get the value today. Right or not? Now. So what is interest rate for 1 year? 12%. What is for 1 month? 1%. 4 months? 4%. Into 1 by 1.04. Are you all follow what I am saying? In that case, I will pay how much price here? 952.91 into 1 by 1.04 is going to give me a bond price of 916.26. What is the price of the bond? 916.26. Today when I buy the bond, I will pay how much for the bond? 916.26. This is the price for how many coupons? 16 coupons. How many coupons here? 16 coupons on redemption. Where one coupon happens what? Immediately after 4 months. Is the meaning. Up to this, everybody having the clarity or not? Now, copy up to this before you go for the next stage. Please copy it quickly. Stop talking, please. Finish copying on? Why I could not write 1 to 16 in the first stage itself? Because the first coupon arises not after 6 months, but after what? 4 months. I could not discount at 6%. There should be discount at how much percent? 4%. Everybody understood or not? Those not copy, raise your hand. Shall I proceed? Please. Can I move to the next stage? Now, so the investor will pay. The investor will pay rupees 916.26. The investor will pay rupees 916.26 as the bond price. The investor will pay rupees 916.26 as the bond price if he purchases the bond today. The investor will pay rupees 916.26 as the bond price if he purchases the bond today. If he purchases the bond today. Everybody, are you having the clarity or not? No. Next question is, this 916.26 even consists of that 50 rupees received on 30th June, right or not? Now, see, 50 rupees is the interest which is given on 30th June because he's buying the bond on 1st March. He'll get the 30th June coupon himself, right or not? Now, tell me, is the entire 50 rupees belonging to him naturally? Because he bought the bond only on what? 1st March. 2 months interest belongs to the previous bond holder and 4 months interest only belongs to him naturally, right or not? Correct, huh? Because he has bought the bond not on 1st January. He bought the bond on what? 1st March. January and February interest belongs to the previous bond holder and the remaining 4 months interest only is a future cash flow. So no? Correct, now, that means I just divide this interest into 2 portions. One is January, February, which I call as what? Accrued interest. How much rupees here? 50 into 2 by 6. 2:4, I divide the interest here. 2 by, how much rupees? 16.67. And March to June portion, how much? 33.33. Respond. Up to this, are you following or not? Now, what the bondholder does is, he pays for the entire 50. He pays for what? Entire 50. Because the previous bondholder cannot collect him only the March to June and then wait for the 50 to be declared and ask for him from the bondholder. Right or not? He will sell at what price? Come interest price. Right or not? The price which I paid, how much I paid for the price here? 916.26. This price also includes January, February interest also. Right or not? Because what we do is, I pay him that interest now itself along with what? Price. So that he cannot come after me after the bond has been purchased by me and interest received by me. Are you following what I am saying? In that case, the price which I paid is what? Come interest price. It includes what? The 16.67 also. Are you following on? No one thing. I did not pay 16.67. I did not pay what? 33.33 the price. I paid only the present value of what? 16.67 and 33.33. Point number 2. Accepted? Because these two numbers is got on 1st March, 30th June, 30th June. That means my price of 916 does not have 50. It has got only what? Present value of 50. Present value of 50 discounted by how many months? 4 months. That means this 16.67, if I discount by how many months? 4 months. 16.67 divided by what? 1.04. I get 16.03. And this 33.33, if I discount by what? 4 months. I'll be getting 32.05. Everybody following in order. So, in this 50 interest, the present value is 16.03 and then what? 32.05. Everybody following in order. Now, take this number. What is the number? 16.03. How much I paid for the bond? 916.26. For 916.26 consists of 2 portions. What I pay for the come interest portion and what I pay for the real bond value. I pay for come interest portion. How much to pay? 16.03. And what is the real bond value? 900.23. Yes or no? Now, this is the value I pay for the future cash flows. And this is the price I pay because this interest belongs to the previous bondholder. Respond yes or no. Now answer me. This 916 is an ex interest or come interest or come interest. You know how many months interest belongs to the previous person? 2 months interest. For that also pay the price or not? Because I paid price not only for the interest to be received, I also paid for price for what? Accrued interest. So the basic bond value is 900.23. And how much I paid for come interest portion? 16.03. Hence I paid 916.26 for the bond. Are you following? Yes, sir. Now, this is what they call as 900.23. The market calls as clean bond value. What is what? Clean bond value. And 916.2 they call as dirty bond value. What bond value? Dirty bond value. Because that is not representing the value of the bond. It also represents what? Yeah, come interest portion. It is only an accounting question. Are you following what I am saying? So 916.26 is a dirty bond value. You know the clean value of the bond is what? 900.23. And the come interest portion is 16.03. Respond. Are you following or not? Now, that is what the exam question also asked you. The question is, can you read the second part of the question or not? Read the question. What amount you should pay to complete the transaction? How much should you pay? 916.23. And of that amount, how much would represent the basic bond value 900.23 and how much represent accrued interest 16.03 is the answer for that sum. A 7 marks question in the examination. Everybody following or not? It will not take time to do it. Only it requires an understanding of bifurcation or dissecting the bond value. Everybody following or not? With this we complete this miscellaneous sum. No concept learned. That's only a bifurcation of the cum interest portion and the real value of the bond. Respond. Are you following up? Now, please copy the next slide. Copy quickly. One minute, just to confirm. See, how I got the 916? Tell me. I discounted 952 by how many months here? 4 months. When I discounted 952 by 4 months, I also discounted 50 by 4 months. Kadaba? Right or not? Now, when I discounted 50 by 4 months, it means I have discounted 16.67 as well as what? 33.33. That adds to 50 by how many months here? 4 months. So, the present value of the accrued interest is 16.03 and present value of the future cash flow is 32.05. Easy answer. Finish copying? Only circle is there, yeah, nothing great. Please copy it quickly. Can I proceed? Please. Stop talking. Finish copying, Nothing, right? Basic bond value 900.23, cum interest portion 16.03. Okay. Write down. This basic bond value is also referred to as this basic bond value is also referred to as clean value of the bond. This basic bond value is also referred to as clean value of the bond. Clean value of the bond. And the bond price inclusive of cum interest portion and the bond price inclusive of cum interest portion and the bond price inclusive of cum interest portion is called, on the bond price inclusive of cum interest portion is called dirty value of the bond. I am not giving the name, the market gives. Is called the dirty value of the bond. Is called the dirty value of the bond. Now clean opposite is what? Dirty. Okay, dirty value of the bond. Okay. Now, please, with this, we have completed the chapter bond valuation. The next sum. I can understand your relief anxiety. Portfolio much more bigger than this. Can you see? Now, warning I am giving. Okay, see. I have completed the bond concepts. One more sum which I am going to do is in bond valuation chapter only. But the problem will be predominantly equity valuation, which will take on to the next chapter called as dividend policy. So just a door will be open through the last problem to the next chapter called as dividend policy. Okay, now please let us summarize the concepts, because so much has been discussed. Before you go for the equity valuation concept, please tell me, what is the value of a bond? All of what value of bond? Present value of the future cash flow discounted at required rate of return of the valuer. Just to take stock of what you have studied and what you know already. Can you see? Now, please. Value depends on two factors. One is the cash flow, another is the certainty of the cash flow called as the discount rate. Next is YTM. What is YTM? Yield. The bondholder earns if he holds the bond till maturity. That is what we call as yield to maturity. For a plain bond, the formula for calculating YTM is what? Interest after tax plus amortization divided by average price or weighted average price, where the weighted average price is 0.6 into S plus 0.4 into M. The right way to calculate it is the IRR of the bond cash flows. For annuity also, YTM is the IRR, where we calculate IRR using discounted cash flow is equal to cash flow into annuity factor. Discounted cash flow is the bond price, cash flow is the annuities which I get, and you know the annuity factor. Known annuity factor, yes, find out the interest rate from the table. Can you see it? Now, for perpetual bond, the YTM is equal to coupon divided by price. For zero coupon bond, you find out YTM using the formula future value is equal to present value into 1 plus R power n. Once we discuss, next we discuss about duration. Duration of the bond can be set in three ways. It is the average period for which the money is blocked in the bond. It is the optimum holding period. Third is the working note for volatility. That is a real way of understanding the duration. Now, the duration is defined as the weighted average duration, where the weights are the proportion of the discounted bond cash flows to the bond price, where the discount rate is the yield to maturity. Duration for a plain bond can be calculated in two ways: table approach, formula. What is the formula for duration? 1 plus y by y minus 1 plus y plus t into c minus y plus divided by c into 1 plus y power t minus 1 plus y is a formula for duration. For an annuity bond, the duration formula is 1 plus y by y minus t divided by 1 plus y power t minus 1 plus y. For a perpetual bond, the duration is 1 plus y by y. For a zero coupon bond, duration is its maturity. Volatility is equal to duration by 1 plus y. 1 plus YTM. And the volatility represents how much a bond price changes. For every price, a percentage change in the yield to maturity. This volatility is nothing but the second derivative of the bond price equation. Is this volatility constant or a function? Function, but we assume it to be constant, due to which the real bond value and the value obtained using volatility will be same or different. The real bond value lies in the curve, but the value we arrived lies in the straight line. The difference is called as convexity. Convexity is equal to 1 by price into 1 by 1 plus YTM the whole square into sigma I is equal to 1 to T into T plus 1 into discounted cash flow for T. Gives you the convexity. What is percentage change in the bond price is equal to what? Volatility into the change in YTM plus half into convexity into change in YTM square. Gives you the real percentage change in the bond price. Next we discuss about the molecular theorem. I am just saying in the order molecular theorem. So where we discuss 5 points. Number 1, the price and yield are inversely related. Number 2, long duration bonds have got high volatility. Shorter bonds having low volatility. High coupon bonds are having low volatility. Low coupon bonds having high volatility. The volatility increases with life. At what rate? Decreasing rate. And the volatility is not symmetrical. The gain which we make through the yield decrease will be more than the loss we suffer due to the yield increase. Is on molecule set. Everybody yes or no? Now. Then we discuss about the concept of bond immunization, where they said, and before we discuss about the concept of realized yield to maturity. Yield is what the bond gives, realized yield is what you ultimately earn. Bond earn depends on what the bond gives and how you reinvest the money given by the bond instrument. In that case, your reinvestment is more, realized YTM is more than YTM, less it is less, and so on. Then we discuss about the immunization. With interest rate changes, you are affected in 2 ways. When the general interest rate changes, if it increases, you are happy because your reinvestment income increases. Unhappy because the bond price crashes, and vice versa. The reinvestment income gain or loss will be offset by the capital gain or loss when you hold the bond till duration. That is what we call as a immunization strategy, where the realized yield to maturity can be protected. Then we discuss about one problem in the horizontal analysis also. Then we discuss about forward rates. A 1 year bond will give you 1 year YTM. A 2 year bond will give you what? 2 years YTM per annum, and a 3 year bond will give you what? 3 years YTM per annum. Every bond YTM gives you the average expectation. Somebody wants to know what is the expectation of the second year. We use to calculate the forward rates. It can be calculated simply using bond bootstrap method in a zero coupon bond and using a complex method for a coupon paying bond. Once we complete our forward rates, I think we discuss about convertible bonds. Convertible bonds combine the features of a share as well as bond. A bond advantage is known cash flows. Disadvantage is lacks sharing of prosperity. The advantage of equity share is shares of prosperity. Disadvantage is what? Uncertain cash flow. If you have a convertible bond, you can get an assured coupon. When the company prospers, make them into what? Equity share. Always convertible bond value will be having more value than a normal share value or a straight bond value. Various concepts about convertible bond also has been discussed in that particular class. Once we completed that, we also derive the volatility formula. We discuss about convexity and also the value dissection, clean value versus dirty value of the bond, are all the issues we discuss in the chapter bond valuation. Everybody following on? 1 or 2 issues regarding beta and bond valuation, everything we will be discussing during the bond futures. That is, in the futures chapter we will be discussing approximately those areas, because in this exam one problem has been asked. First question a bond only in this examination using forward rates, where beta value of the bond also has been given. Apart from that, remaining has been known to us. All that will be knowing when I discuss beta in portfolio and the futures also in bond calculations. Can I proceed? Now, most of the things regarding the bonds are over, but still we have not discussed about interest rate swaps, currency swaps. All are coming only from the bond chapter only. Those things will be discussing during the area derivative segment. Everybody following on? So they are always putting a comma. Comma to IFM, comma to what? Bond. All this comma will become full stop only when you go for what? The derivatives later. Everybody have the clarity or not? Now.
Thank you friends. OMSAI Bhojanapalli.